S&P 500 down 0.10% at 7,498.96. The Dow, virtually flat, down 0.01% to 52,218.58. NASDAQ down 0.60% to 25,690.90.
And, you look at that closing print and the surface narrative writes itself.
Right.
It looks like a standard pre-earnings holding pattern. Traders just flat out refuse to take directional bets ahead of megacap tech, specifically Alphabet and Tesla, dropping after the bell.
But the real risk here is assuming that's all it is.
Exactly. Defining today's session as a neutral holding pattern completely ignores the reality of the tape. Today was a choppy mess. It was a classic, calculated pre-earnings de-risking tape.
So the core question for you, if you're actively managing a portfolio today, is whether this is just a temporary holding pattern or if the combination of sticky yields and rising oil is about to just cap the artificial intelligence bull run.
To answer that, you have to look away from the flat index numbers. You have to zero in on the macro squeeze driving the day's sector rotation.
Well, let's look at the data execution on that. We had a massive spike in crude oil today. WTI was up nearly 3% to $86.80 a barrel. Brent crude pushing near $95 a barrel, due directly to the Middle East escalations.
Which forces a reaction in the bond market.
Exactly. We saw direct resulting pressure on fixed income. The 10-year Treasury yield ticked up to 4.63%.
Yeah.
And that gave us the extreme sector divergence. Utilities led the tape, up 2.28%, while communication services lagged behind, down 1.29%.
And if you look beneath the surface, the macro translation is just basic math. I mean, multiple expansion in long-duration growth tech cannot coexist with 4.63% yields and $95 oil.
The discount rate applied to future cash flows gets mechanically punished.
Right, mechanically punished. And that utilities pump we saw, that wasn't just safety seeking.
No.
It's a defensive play, sure, but it is combined with a backdoor play on AI data center power demand.
But I'll challenge that a bit.
Yeah.
I mean, this defensive rotation into utilities, couldn't this just be standard pre-earnings jitters? I'm not seeing a guaranteed structural top here just because yields ticked up.
If you want to know if it's just jitters, you demand to look at the market breadth and the volume. You have to see what the smart money is actually doing, not what the narrative says.
Well, looking at the internals, they were undeniably weak. Only 42.8% of U.S. issues were positive today.
Right.
The Russell 2000 was slammed, down 0.90% to 2,959.94. But the most important metric here is that total exchange volume was moderate, strictly below the 30-day moving average.
And that is the institutional tape speaking directly to. Because the volume confirmation isn't there on the downside, it means it wasn't systemic panic, right?
No forced liquidations.
Exactly. It was a clear refusal to commit capital. Institutions explicitly faded the rally. The tape is just littered with key reversals that prove this, starting with the global macro setup overnight.
South Korea's KOSPI.
Right. The KOSPI gapped up 4% overnight. Historically, that sets a massively strong tone, but it suffered a massive reversal to close up just 0.7%.
Right.
That set a very weak tone globally.
Which transferred directly to the AI hardware space in the U.S.
Right.
Semis, names like Micron, Intel, SanDisk, they tried to stabilize early in the session.
They tried, but look at the final hour. They were aggressively sold off by nearly 4% into the close.
Algorithmic distribution.
Right into the bell. And the software side was even worse. Look at UiPath, ticker PATH. That was a sharp key reversal.
Sliding 13%.
The 13% wipeout. 2 months of gains gone as growth software multiples were forcibly repriced.
But wait, capital isn't completely fleeing the market. You look at AT&T, up 4% today. Philip Morris breaking out. The capital is just demanding tangible value and high cash flows over long-duration growth, right?
I agree with that. The reallocation is real. But rotating into telecom won't save the S&P 500 if big tech cracks.
Because the market kept waiting.
Exactly. It's a math problem. Which brings us to the most dangerous anomaly on the board today. Despite the ugly internals and all this tech weakness, the VIX actually dropped.
Yeah, the volatility index slipped 2.35% to settle in that 16.6 to 17.2 zone, which suggests the market isn't panicking at all.
I completely dismantle that calm narrative. Today was VIX expiration day.
Right.
Options traders were structurally crushing index-level premium ahead of the mega-cap earnings. That mechanical crushing of the VIX is masking massive, dangerous, single-stock dispersion.
So the calm is manufactured.
Highly manufactured. There are 3 glaring red flag divergences in the tape that prove this. First, VIX versus price. The VIX fell, but SPX and NDX closed red.
The S&P actually tried to break 7,515 intraday.
It did. and it got firmly rejected. It drifted aimlessly back to the 7,500 pin. When a falling VIX can't force the market higher, that signals total buyer exhaustion.
And the second divergence.
Index highs versus small caps. The S&P is hovering within 1.5% of record highs, right?
Yeah.
But the Russell 2000 just erased its recent gains in a single session.
It's the duck metaphor. Calm on top, but furiously drowning underneath because small caps rely on floating rate debt, and that 4.63% yield is toxic for them.
Exactly. And the third divergence is energy versus tech. Surging Brent crude and higher yields are injecting fresh inflation fears.
Which directly threatens tech valuations.
Not just valuations, it threatens the AI capex scrutiny. If inflation stays sticky, the cost to fend these massive data centers skyrockets.
So how does this translate to actionable mathematical levels for Thursday's open? Because we have to talk about options gamma.
Right. The options pin is everything right now.
The S&P 500 closed at 7,498.96. The desk models show core support and the gamma pivot sitting right at 7,500 to 7,488. We close directly on the strike axis.
And the consequence of that axis is binary. If the market holds 7,488, dealers stay in positive gamma. They act as shock absorbers, absorbing volatility by buying dips and selling rips.
But if 7,488 breaks decisively,
then market makers flip to negative gamma, and that forces systematic delta hedging. They are mathematically required to short the underlying index to balance their books, which will accelerate selling pressure down to 7,440.
So what's the institutional setup for tomorrow?
The asymmetric trade is long energy, so oil, XLE, crude, versus short high multiple growth and software.
Hedging against macro inflation colliding with AI capex scrutiny.
Exactly, but if you're trading individual names, what are the targets?
For the day 2 play, we are watching Alphabet, ticker GOOGL. They reported tonight. Watch the first 15-minute opening range tomorrow.
Right.
If it holds pre-market support post-earnings, look for a day 2 play as institutions realign capital into cloud winners.
And on the defensive side?
AT&T and Philip Morris. We're looking for earnings momentum continuation. Long entries on shallow morning pullbacks, as long as they hold above Wednesday's breakout levels.
The final warning for anyone trading Thursday's open is this. The probability of today's ranged shop continuing tomorrow is exceptionally low. The models give it a 30% chance.
So we are expecting movement.
The probability for aggressive, news-driven directional expansion on Thursday's open is 70%.